So welcome to our third panel. We're very pleased to have a great set of regulators, former regulators, to talk about the regulatory environment and how it affects capital markets. We're going to start with Paul Atkins. Paul is currently the Chief Executive of Potomac Global Partners. From 2002 to 2008, he served as a commissioner in the U.S. Securities and Exchange Commission, and during his 2 terms, he advocated better transparency and consistency in the SEC's decision-making and enforcement activities and smarter regulation that considers costs and benefits. Our second speaker will be Greg Berman. Greg is currently the Associate Director of the Office of Analytics and Research in the Division of Trading and Markets at the SEC. Mr. Berman covers a wide array of areas, including equity market structure, clearinghouse risk, derivatives transparency, broker-dealer capital. Before joining that division, he was co-deputy director of the Division of Risk Strategy and Financial Innovation, where he also worked with the SEC's financial economists. Last but not least, we're pleased to welcome Kathleen Weiss-Hanley. Kathleen is currently a visiting associate professor of finance and senior academic advisor to the Center for Financial Policy at the Smith School of Business at the University of Maryland. From 2011 to 2013, she was the deputy chief economist at the SEC. So we have some pretty good representation of the SEC, so I'd like to turn it over to Paul. Thank you.
Well, thank you very much, Martin, and thanks for your kind introduction. It's great to be able to be here today at this conference and speak to you all. I've been out of government now for about 5 years, and the last tour was there with this Congressional Oversight Panel for the TARP program, so I've been ensconced in Dodd-Frank and other things now for the last few years. And so I really think this is a timely conference, and there are many challenges that face our capital markets in the current environment. I only have 10 minutes here, and so it's quite a challenge for me to cover all the things that face the market. So I can only paint, of course, with broad strokes. But the markets, let's just say, I think, are resilient, and mainly because they're made up of human beings, ultimately. At the same time, it's not a grand machine. It's not impervious to outside forces. And why is that? It's because human beings ultimately make up the markets, even if we have machines that also are involved to facilitate trading, communications, and other functions. But market participants, as well as regulators, act on imperfect information and make many mistakes. The regulators challenge those to set appropriate rules of the road, but to get out of the way and allow savers and investors to do what they need to do. Government, of course, has a necessary police role to ferret out criminality, people who would steal from others, but government must do its work through due process and the rule of law, adding as little friction as possible, and it is costs that make sure that costs do not outweigh benefits. Else, investors ultimately pay the consequences over the long term, and sometimes not so long term with their results from investments. Congress, I think, got it right in 1996 when it passed the National Securities Improvements Act, and it added 2 prongs to the SEC's traditional mission of investor protection. First, maintaining fair, orderly, and efficient markets, and secondly, to facilitate capital formation. Other regulators have different missions, and I think it shows in their activities. The Federal Reserve Board and other banking regulators' mission is safety and soundness of the banking system and the financial system. Sometimes this veers off into coddling and protection of the regulated industry, as we saw with the Federal Home Loan Bank Board and its fanciful treatment of regulatory capital that led to the S&L crisis back in the 1980s. Because right now, we do not have true transparency with the bank regulators, including a real audit. We will never exactly know what goes on with bank regulation until, as in 2008, it's too late. So in my time with you today, I want to focus on 2 huge challenges that face the markets today. The first is growth of legislation and consequent regulation from Washington that's not grounded in the causes of the financial crisis, and it is not predicated on valid cost-benefit analysis. Second is the politicization of the regulators, powered by a false narrative of the causes of the 2008 financial crisis, and outside political interest groups that feed off of that narrative. The consequent growth of regulatory costs, the uncertainty in the business and investor world over the path of future regulation, and the inhibition of innovation retard growth in the markets and investment. So first, let's talk about the growth of regulation. The seminal event, of course, was the passage in 2010 of the 2,319-page-long Dodd-Frank Act. Now, Dodd-Frank was not subject to what regulators or legislators call regular order. Few substantive hearings were held, even on its major provisions, such as the Volcker Rule, which was thrown in at the last minute, more or less, not to mention supposedly minor provisions, which have turned out to be major headaches because of poor drafting. I think it was truly a travesty of the democratic legislative process. And no wonder Chris Dodd famously said about his own bill, quote, "No one will ever know until this is actually in place how it works." About the only thing well planned about Dodd-Frank was its focus group tested name, the Wall Street Reform and Consumer Protection Act of 2010. Now, one leitmotif that permeates Dodd-Frank is found right from the beginning: the notion that government can make financial markets stable. I call it stability über alles. The world has never seen a stable market. One could point to totalitarian states like Cuba and the old Soviet Union, but active black markets belie that supposed stability. China is hardly stable, maybe North Korea. The conceit of authors of Dodd-Frank, which is carried on to this day, is that if you get enough smart people in the room and enough data, that they can bring stability to the marketplace. But just as human beings are hardly stable, those of us who are market participants know that the markets are not always stable. So Title I of Dodd-Frank is called Financial Stability, no accident, and it created the Financial Stability Oversight Council, or FSOC. It has the authority to designate entities within the financial services industry as systemically important financial institutions, abbreviated SIFI. Now, former Congressman Barney Frank once quipped that SIFI, as some pronounce it, sounds like a venereal disease. I think that's probably right. But I would argue that a more accurate and appropriate pronunciation rhymes with hi-fi and Wi-Fi, so thus sci-fi. And it has a homonym, of course, no accident, also appropriate in the shorthand that we use to describe science fiction. So far, FSOC has designated 4 non-bank financial companies and 8 financial market utilities as sci-fis, subjecting them to the Fed's prudential supervision. During the past 18 months or so, the FSOC has turned to so-called shadow banking to look for systemic risk. In September of 2013, the FSOC's handmaiden, the Office of Financial Research, issued a poorly conceived, even more poorly executed report on the asset management industry. It lacked meaningful analysis and was replete with inaccurate, really inexcusable, inaccurate data and unsupported assumptions. It even got basic concepts fundamental to the law and function of the asset management industry wrong, including a seemingly lack of distinction between funds and their managers. It's disturbing to me that such shoddy scholarship informs FSOC decision-making. The FSOC is not the only actor in this space. An even more non-transparent, non-accountable group of regulators is the Financial Stability Board. A creature of no statute or treaty, it's a club of regulators that claims its remit from the meetings of the heads of state of the G20. Through its meetings and policy pronouncements, it evidently drives policy decisions in the United States. So contemporaneously with events in the United States, this FSB has been studying the asset management industry. It issued a consultation on potentially significant mutual funds, and the only mutual funds that met the materiality threshold in the consultation were American, basically because Europe does not have a capital markets to the same scale as the United States. There's no transparency or accountability with respect to official American participation in the FSB process. These meetings and activities are closed. In fact, an American governor of the Federal Reserve sits on the FSB and even chairs its working group that's focused on the asset management industry. So from my experience with bodies of international regulators, there is no way that the FSB would be doing any of its activity, especially calling out American firms and practices, without the acquiescence of the Federal Reserve. Thus, the widespread suspicion is that the Federal Reserve is using the FSB as a bootstrap to build a framework and momentum to get done through an even more opaque backroom process that's that it's not able to accomplish in the United States. Well, with a 2-minute warning there, let me skip forward to the growing threat I view from the politicization of regulators and especially of the SEC in particular. And one reason, of course, is the Dodd-Frank Act itself. And what else would one expect from a huge bill with so many flaws that was pushed through Congress on essentially a party line vote? Thus, the rules spawned from the poison tree will themselves be hard to find compromise. So compare the Sarbanes-Oxley Act of 2002. Not that I hold that statute as a pinnacle of legislative accomplishment, but it passed with huge majorities in each house, and the SEC under Harvey Pitt, who was then chairman while I was there, was able to find common ground among commissioners who were, in fact, no wallflowers on either side. The rules adopted, including defining financial expert and reporting of misdeeds by insiders, were subject of a lot of internal debate and compromise. Today, though, that seems not to be the case. Believe it or not, there were no 3-2 votes along partisan lines from 2000 through 2009. There were 3-2 votes, but commissioners were split by other than party lines. Since 2009, the beginning of this administration, there have been about 20 3-2 party line votes. So rulemakings from Dodd-Frank, I think, are the culprit, but also there's a lot of outside agitation. And so I ascribe a lot of the current situation to outside politically motivated groups. And one example is a push by politicized advocacy groups to try to pressure the SEC into adopting a rule requiring corporations to disclose their so-called political expenditures on trade associations and lobbying. Federal and state election laws already cover this, and this information is not material to shareholders. And shareholders, in fact, overwhelmingly vote down these sorts of proposals. But the pressure groups have nonetheless, tried to continue their agitation. But this is just one example. Dodd-Frank itself has many examples of other things that Congress has foisted on the SEC that are not material and, in fact, don't respond to the financial crisis of 2008, which I think is our number one goal. So anyway, with that, thank you very much.
Good afternoon. My name is Greg Berman from the Securities and Exchange Commission. I hate to start off with an apology, but I will. I do need to, unfortunately, leave right after this. I have an unmovable commitment, so I won't be around for questions. But if you do have questions about anything I say, please feel free to email them to me directly. Normally, when I start out and say that I'm from the SEC, I'm also required to make sure everybody knows that these are my own views and not the views of the commission or any of my colleagues at the commission. And that's important because these certainly are my own views, and I have a lot of views. A lot of views about markets, a lot of views about capital formation, and in fact, a lot of views just based on what we heard at the first two panels. But given we only have about 5 or so minutes, I'm going to try to focus on exactly one very, very precise view. I was here last year, I think, Doug, it was in January of last year, that we had a small panel on market structure. And that's most of what I tend to focus on. The Division of Trading Markets is on market structure. I'm not a lawyer, so when I first got to the SEC, I had to learn about the different rules and regulations, but also took a lot of cognizance of the fact that the way that we're structured and the way that the entire dialogue tends to get structured has to do with the acts that were passed in Congress. So we have the Primary Act about the primary markets in 1933. Then we have trading and secondary markets in 1934. And then, of course, in 1940, you have a pair of acts that go to investment advisors and investment companies. And everything tends to flow from that, including much of the dialogue about capital formation and capital markets. What do I mean by that? Well, there's been an uncountable number of conferences over the past 24 months on market structure. And you will generally find a bifurcation in both who's at the conferences and what the nature of the adversarial relationships between different parties are. And it normally goes like this. There's buy side on one side and there's sell side on the other. And there are buy side conferences and there are sell side conferences. And there are conferences where everybody gets together and they want to talk about what does the buy side need from the secondary markets So from the broker-dealers and from the exchanges, from off-exchange trading. And then there's what information do the broker-dealers need from asset management community. And I think that's a very healthy distinction. And it certainly fits in line with the difference between the 1940 Acts and the 1934 Act. But when I take a step back, and as Paul mentioned, one of the things that were added to our mandate is capital formation. So when I take a step back and I look at capital formation, I'm not sure that framework of a bifurcation between the asset management community and the sell-side community is particularly instructive. In fact, I actually think that it might be more harmful than instructive when thinking about the real aspects of the markets and capital formation. So I have a very, very simplistic view of the role of capital formation in the framework. On the one side, you have natural persons, people who work, they have some money, they have excess free money, enough that they are willing to actually lose a significant amount of that, and with that, they would like to buy a business, and instead of giving it to their brother-in-law to start up a used bookstore or something like that, they find that maybe I want to reach out broader. I want to give it to large companies, to small companies, but it's their money, and they would like to invest it directly. On the other side of that spectrum, you have companies that need to bring that money in, and a lot of the focus tends to be on how do they bring the money in. I think we should keep in mind that that's called capital raising. Capital raising is not the same as capital formation. You sort of have to have that next step where the companies then need to do something with that money that actually creates new capital. Certainly, if you get money from a bond, we call that debt. That's not even actually capital. That doesn't go into your capital account. That goes into the debt side of the ledger. So it's really around the capital formation, and that brackets. Now, when I look on the inside, I think about the secondary markets and what's the point of the secondary markets. I think we've heard a lot about that today, and the secondary markets play a critical role that they can never be compromised, because without those secondary markets, that chain between individual investors and between corporations doesn't work. But what sits in between that chain are a host of intermediaries. Very, very broadly, I think that includes both the buy side and the sell side, because both are trying to service both sides of that spectrum. And when I look at the detailed data that we have produced at the SEC over the past 3 or 4 years and talked with so many different asset managers and so many different broker-dealers and the exchanges and what asset managers are trying to do on the exchanges, I find very little difference between the spectrum of people who say, I need to trade very quickly, maybe on the second or the half a second or the millisecond, in order to create an execution algo to buy and sell in a more efficient manner, or to provide liquidity, versus people who say, I'm a long-term investor. I only need to rebalance my portfolio once an hour, or once a day, or once a week, because I have a mandate that says I have to be better than all of my other asset management competitors, and therefore I have to trade. Because if I can't trade, then I lose my competitive advantage to attract clients who themselves are the end investors. So when I think about capital formation, I take a really far step backwards and recognize that the asset management community on the buy side and the sell side collectively can be viewed as the intermediaries between those two brackets. And when you start to think about the nature of the debate in secondary markets, having those two things bifurcated, I think really belies what some of the real key issues are. Everybody needs secondary liquidity, but they need them for very, very different reasons. For capital formation purposes, what you really should be looking at is what are the secondary liquidity requirements of investors, here, natural persons who have the dollars, it's their money, and what are the liquidity requirements of the issuers? The liquidity requirements of everybody else in the middle is there pretty much to serve those end brackets. Sometimes at large conferences, we spend a lot of time considering what are the needs of everybody who's in the middle. And that's a healthy discussion. It's a great discussion, but it's not the same necessarily as thinking about what are the needs of the people on the ends of the brackets that are really responsible for capital formation. Thank you.
Thank you as well for inviting me. So I have had a career as both a regulator at the SEC and the Fed, as well as an academic. And my research has focused on this intersection of capital formation and investor protection. And in particular, I'm very interested in how regulations affect decisions by corporations or by investors to invest in companies. So I thought today, and this I think is a nice segue from what Greg was talking about, these end users, for us to take a little bit of a closer look at the Jobs Act, which Jim raised and which others have raised here, but also has an impact on how capital formation occurs, but it needs to balance the investor protection mandate. So I have some research in this particular area that might be useful in framing some of the discussion. So as been pointed out, that smaller public companies have not been going to our capital markets as frequently as they have had in the past. This is not a worldwide phenomenon. It is generally a U.S.-based phenomenon. So this is some statistics from Jay Ritter, who looks at very small firms, those that raise 50 million or have revenue of 50 million or less. And as you can see, after the tech bubble burst, the number of smaller public companies has gone down quite a bit. And of course, there are many, many reasons why this might occur, many of which were teed up. I'm only going to tee up one because we're talking about the Jobs Act, and they only really addressed one channel by which, or generally one channel by which they could remedy the situation, and that's the high costs of not only going public, but staying a public company. And in particular, issuers can spend up to a quarter of their proceeds in both direct costs, those costs of legal fees, accounting fees, and underwriters, and the first day return that they have. So many, as you know, IPOs come to the market. Everybody's very excited about them because they have a huge return on the first day. And so that's really exciting, except it's not so exciting for an issuer, right? Because that is a cost of capital for that issuer that they could have had the price been raised a little bit higher. Now, I'm not saying that all prices could have gone higher. I have a broad research agenda that suggests not, but it is a high cost of accessing the capital markets and one firms have to be aware of. And then once you get there, you have these compliance costs, whether it's Sarbanes-Oxley, which many, many, many studies have shown is quite expensive, or you have ongoing compliance costs through your periodic reporting and insider trading. So it is not a cheap mechanism by which to raise capital, but it has many, many benefits, and there have been a number mentioned today. So what did the Jobs Act do? The Jobs Act did many things, and thanks, Jim, for teeing up some of the private issues that the Jobs Act raised. But it also tried to provide a public on-ramp for emerging growth companies, which I'll mention in a moment, to reduce the regulatory burden of going public. And so I have a paper with Susan Chaplinsky at the University of Virginia and Katie Moon at the University of Southern California that tries to examine whether the Jobs Act was successful in lowering the cost of going public for these firms that have just started to access the capital markets after the passage of the Act. So this specific act specifically targets the IPO process, and it allows companies that have $1 billion or less, there are a couple other factors, but the primary one is $1 billion or less in revenue, to qualify as an emerging growth company. So if you looked before my slides went up at the little bird at the top of the screen, Twitter was considered an emerging growth company. There's been a lot of debate on whether $1 billion is a smaller public company. One might argue that we would all like to own a company that has $1 billion in revenue, and that's going to play, I think, into some of the findings that we have with respect to the regulations that have been put into place for these larger companies. So there are reduced disclosure requirements that may have on their prospectus and ongoing, and you're allowed to confidentially file your registration statement with the SEC and to test the waters before going public. So the intended benefits is obviously to reduce the costs of going public for smaller companies. So you can both have reduced financial disclosure, executive compensation disclosure, And you can also not have to comply with Sarbanes-Oxley 404B, as well as some of the DFA say on pay rules. You can minimize the probability of a withdrawn offering by confidentially filing with the SEC, and that draft registration statement doesn't come to the public unless you choose to move forward. If you choose to withdraw, you don't have to make that known to anyone. And this lower disclosures maybe could allow firms with high proprietary costs of information to reduce that disclosure and keep it private from competitors. This gives you a sense of sort of the increasing willingness of firms to adopt some of these lower disclosure regulations on going public. So this is a timeline of filings of the number of firms that said yes to the exemptions that were given. So this is in the bars, the blue is confidential filing, the red is testing the waters, and the green are reduced financial statement disclosure. And as you can see through time, particularly for confidential filing and testing the waters, all of these provisions are being used more and more by companies. We don't see any increase in the usage of or the taking of the SOX and Dodd-Frank executive comp rules, as well as the delay of accounting standards. So there is an increased willingness for these companies to determine to use the benefits of the Act. Now, part of the problem is that a broad set of research and the Commission itself has studied the fact that disclosure generally provides valuable information to investors, and that if you want to increase transparency in the market, disclosure can be a powerful tool in which to do that. And generally, securities regulators have focused on increasing information to market participants, not necessarily decreasing it. And so one of the potential costs of this act would be to actually increase the costs of going public for certain issuers, in which the information that they choose not to provide would be valuable to an investor in an investment decision. And so what do we find? We have a very short period of time, so I can't tell you everything, but we look at what the act does. So the act gives to larger, much larger companies. In fact, if the Jobs Act were in place prior to 2012, 85% of all companies who went public would be eligible for the provisions of the Jobs Act. So essentially, the Jobs Act has changed the entire criteria of what it means to go public as far as disclosure is concerned. In addition, every company but 3 in our sample who were eligible to use the Jobs Act chose to do so. So companies are taking advantage of many of the provisions of the Act. In addition, when we look at what the Jobs Act did, it took scaled disclosure that the SEC had for smaller reporting companies, those companies that had $75 million or less in float, and gave them to very, very large companies. So the SEC has, in its wisdom, thought very carefully about scaled disclosure for small companies and what should be different types of disclosure for larger companies. The Jobs Act decided that even very large companies should be able to avail themselves of smaller reporting company disclosure reductions. So what do we find? We find that smaller reporting companies are generally not affected by the Act, either through their direct costs or through that initial pop on the first day. Right? So smaller reporting companies had many of the provisions of the Act prior to the Act, and they do not seem to be very affected by the passage of the Act. If you look at larger companies, those above $75 million in offering, we find that not only has their direct costs in some instances actually gone up, but their underpricing has gone up as well. So that initial return is higher. We interpret this to mean that the cost of capital for larger companies under a lower disclosure regime may have actually increased rather than decreased. And so at the end of the day, our findings provide some evidence on how regulation needs to right-size its requirements to meet the demands not only of issuers, but also of investors. Thank you.
Okay, well, we're by one, but we'll Okay, let me start with you, Paul. That was a pretty stiff broadside against Dodd-Frank. So let me just separate a couple of the issues out that you raised. One was with respect to process, and you described the Dodd-Frank Act as sort of being rammed through as a not a bipartisan, but on a Democratic vote only. Why do you think that was? I mean, you could argue that the reason that happened, I mean, there was a lot of effort to try to get a bipartisan bill. But don't you think at some point the Republicans said, we don't want to give Obama a victory, so we're not going to take part in this? I mean, who was really responsible for?
Well, I mean, it's longer than what we can treat here, I think. But I do blame it on the administration, actually. I think there was a decision made to make this a test and to have something to stand on. And I think if you look at the lack of real hearings, and I mean, you talk to folks on the staff and senators as well about how it was crafted. I mean, basically you had people like Gary Gensler sitting on the floor outside of the conference committee room, writing in longhand things to then be passed in to be inserted into the master of what people were going to vote on. And so truly nobody had any idea what they were voting on at the last point, and so it came down to a real party line vote. So I think it was meant to try to draw a line in the sand to call out supposed differences.
But if we look now at some of the fights over financial institutions or over markets, that actually is somewhat bipartisan in the sense that you have folks on the left and on the right that are both, making common cause to on some of these issues. So how do you view that process?
That's a great point, and we've seen that unfold over the last year or so, especially with respect to as the FSOC has looked at asset management. I think there are people on both sides of the aisle who have realized that what this portends as far as the ability of the Federal Reserve and the FSOC to dictate activities of participants in the capital markets. For example, if there be instability in the marketplace, if they have gone ahead and designated activities, they could ask people to forbear in selling particular instruments or whatnot, despite what they think their fiduciary duty is or what their own interests, personal interests are. And so I think that's a very disturbing prospect for the markets.
Well, let's focus specifically on capital markets, which after all is the topic what we're talking about here. So what would you see as being the most problematic things in Dodd-Frank or in the subsequent implementation of Dodd-Frank in terms of how it's impacting capital markets? What are the things that are the biggest challenges that need to be dealt with? And obviously you've talked about this, but it was in fairly broad terms. Can we focus on what you think is creating the biggest problems?
Well, going back to the uncertainty. So we have mandated out of Dodd-Frank, depending on how you count, between 250 and 500 some odd rules. And the CFTC, for example, takes pride, it says, in having met its obligations to adopt various rules. But it did so, I'd say, in some cases, not under normal ways of due process or compliance with the Administrative Procedure Act. And so now it finds itself having to go back and actually look at what has been adopted to try to figure it out. The SEC has taken a more deliberative road. It has done maybe about half of the mandated rules. But unfortunately, I think the chairman or two ago took more of a political line and went after rules such as conflict minerals, mineral extractive disclosure, that sort of thing, that have very little to do with the financial crisis of 2008, but more of a political sort of bent. So again, going back to what is the problem with the marketplace is, I think, this uncertainty that's overhanging as to what actually the rules are going to be, even if one thinks that something, for example, with respect to swaps or CEFs or whatever, is a final rule of the CFTC that might not be so final because people are reviewing them again. Position limits, things like that, are subject to a challenge in the court. And so that even makes more uncertainty out there. So it's hard to run a business. It's hard to look into the future. People demand then a risk premium, to go into the market that way.
Okay, let me give you one more question, and then I'll turn to Kathleen. You also criticized the Financial Stability Board. When I talk to financial institutions and other people I know have echoed this, there's great concern that we don't want financial market regulation to vary across country because it's too confusing. And I've heard a lot of bankers say, first of all, we want to know what the rules are, so I agree with you on the uncertainty, but we'd also like them to be sort of the same because a lot of these financial products are essentially global products, and they're sold globally, and the institutions, the securities are sold globally, and so on. So, okay, you don't like the FSB. How do you think we're going to get that convergence, or do you think we need to have that convergence?
Well, I think you need to have convergence. And so FSB, if you look around the table, it's mostly bank regulators, central bankers. Right. And so with respect to capital and other things, we're talking about competitiveness issues cross-border. And so depending on, it's better to have consistent rules. But what we're seeing now with respect to what the FSOC is talking about and the FSB is talking about with respect to the capital markets, that's actually going into new territory altogether, and especially with respect to jurisdiction, authority of the various entities on a national level, it's very much questionable, I think. So that's not necessarily a level playing field. That's now trying to aggrandize either authority, unto particular institutions, or get to perceived advantages by various international participants.
I'm guessing you wouldn't be too enthusiastic about putting financial services into the transatlantic trade negotiations.
Well, that's that's a bigger issue altogether. I think that
it's another way that you might get more uniformity.
There could be a place for that, but there are a lot of competing interests to take care of there.
Okay, so let me turn to you, Kathleen, and thank you for your presentation and the results of some of your studies. So let me ask you then, we talked earlier today about small companies going public, and that the regulatory structure is making that difficult, or it's making that costly. You mentioned Jay Ritter's finding, although I think it was Jay that I quoted in the earlier panel who thinks it's more a change in the business model. So do you think this decline in the number of IPOs, what would be your explanation of that? And do you think it's problems in the capital markets that's causing that?
Well, I do tend to agree that there are market structure issues with smaller public companies that could potentially be changed. If you look at the number of investment banks that used to bring these smaller companies to market, there are very few of them existing today, so I think that can be an issue. I don't think, again, like the first panel mentioned, that there is one particular focus. Certainly the technology, I tend to agree with Jay to some extent that many of the companies that went public had poor earnings over the next few years. And if you look at the companies that are going public after the Jobs Act, the vast majority of them are unprofitable, and most of them are VC-backed. So that begs the question of why...
Well, when you say unprofitable, if they're on a very sharp growth trajectory, they may be investing a lot. Does that necessarily mean that they're bad companies?
No, of course not. But it does mean that they're potentially riskier companies,
Yeah.
right? So they have negative net income. And so it is the case that, it is very difficult to, determine the one reason. And then I think it's the same thing when you look at things like crises and other things. It's a combination of things. I don't think there is a panacea, however, to getting smaller public companies interested in the public markets. Where I'd like to see research, which is hard to do because we don't have the data, is what is the trajectory of a company that remains private today, right? So we know those that are sold, or we know those that get venture capital money, but we don't always know the outcome of having private firms, and maybe that's a better use at this point of some of these companies' capital.
Now, when the Jobs Act came out, I supported. Bob Lighton and I wrote an op-ed supporting it, although we put some caveats in there that we need to do a lot of research, and this is the research that you've been doing. So what's your verdict then? Do you think it was a mistake? Do you think it needs to be modified, or do you think it will work itself out and turn out to be a benefit? Your results you presented look to be fairly negative towards it.
I think it's negative toward very large companies. For the smaller
Maybe I
companies, I
misunderstood.
think confidential filing, testing the waters are all potential benefits for them. But
I thought I understood you saying that it actually turned out to be more costly to go public.
if you are a large company who are newly eligible for these,
I misunderstood.
right? So there is a group of companies that have always had the reduced disclosure. These are smaller reporting companies that have always had the reduced disclosure, and they were unaffected by the act. But these larger companies that now are availing themselves of what used to be smaller reporting company regulations are having higher costs of capital when they enter the public markets. Now, the act is only a few years old, and so that's not to say that in time these companies will not, or the market will not adjust to this. But initially, taking advantage of those reduced disclosure requirements at the end of the day may not have helped capital formation at that end of the market.
One thing to
Yes,
throw
I'm
in,
interested because this was a bipartisan measure, the Jobs Act. There was a lot of enthusiasm for it, so I'm interested in your reaction.
Well, but also, so my view of it also kind of spans a broader time frame. When I was a young lawyer, I was chief of staff to Richard Breeden in the early 90s, and in 1992 we came out with new rules for small companies to try to encourage more free writing by company management to describe their business, try to lessen the burdens of small businesses, their costs of lawyers and accountants and everything else, but then trying to balance the fear of fraud and whatnot. So I think the Jobs Act was motivated by what I think Jim Angel pointed out earlier today is the precipitous drop of companies going to market, which then affects, of course, private equity, VCs, because they want an exit strategy. And if the public markets are not there, as Greg Berman pointed out, the markets serve many different participants. And so, that's why I think your research is very interesting to show that, the Jobs Act was a response to this precipitous fall, which had its basis in Sarbanes-Oxley, as you pointed out, in the financial crisis. So there are many different influences to it, but I think this is part of a long-term trend of people trying to figure out how can we make the capital markets work for all sorts of different participants.
Well, I'm going to open this up for questions, but I'm going to just make an observation and then ask if you have any comments. Josh Lerner from the Howard Business School and I co-hosted a conference in Silicon Valley recently among venture capital folks. And it really was quite staggering. First of all, when you're in California, especially in Silicon Valley, how optimistic everyone is. I mean, it's really like, things are going gangbusters. I heard the comments, innovation has never been more rapid. There's never been more innovation taking place. So there's a tremendous amount of optimism. And the other thing that struck me was the huge amounts of money that are now sort of available in venture. It's hard to find the place to put it. And some of the venture capital firms were saying, we get visited by foreign sovereign wealth funds who have, $1 trillion to deploy, and they're trying to figure out where to put it. So somehow there's lots of money out there. Apparently there are lots of opportunities for innovation out there. Are capital markets doing the job, or is it because of Dodd-Frank? What's the prognosis here? Are you going to bring the capital markets and the opportunities together in some way, or are you pessimistic about that?
Well, no, I'm optimistic.
Good.
I think as more people study the effects of the various things that have happened, and part of the Jobs Act too is not just for the capital markets. You have to look at Reg D, 506.
Right.
The attempt to open that up, and then Rule 144A, which was adopted back in the late 80s, mid 80s, which really opened up the world for institutions to buy and sell securities in a private marketplace that provided a lot more liquidity outside of the public markets. I think all of those things are a cause for optimism. And when you look at the resiliency of the American capital markets versus in Europe, where because they lack optimism, they lack an investor culture, everything is basically centered around the big banks, and now the European Union is trying desperately to figure out how do we support capital markets. It's trying to push on a string, I think, until they really build an investor culture where people do have optimism and future growth like what you're describing in Silicon Valley. I think is what we need to try to find. The downside, of course, is the regulatory beast that I was talking about, and then the propensity of central bankers now to try to get their claws into the capital markets, and then to import, like Governor Turlo has been talking about. He's coined the term prudential market regulation. So that's what I was trying to say. I didn't really have time to get into it, but the prospect again of the central bank being able to order market participants to forbear, not to be able to sell their securities that they think they need to, and basically take one for the team. When I talk about this and people say, oh, that could never happen, that's crazy. It is crazy, it could happen, and all I have to do is point to the TARP program where sound banks were forced to take TARP money just so that the bad banks would not be called out in order for to supposedly maintain stability of the marketplace. Stranger things can
We
happen.
could have an interesting discussion on that and whether that was overall a success or a failure. But, I was a member of, not of this administration, but a previous Democratic administration. So I have to restrain myself occasionally on your comments. But Kathleen, so do you see the regulatory beast preventing this? I'm not trying to put you on the spot. But
I think regulation needs to always be very cognizant of its unintended consequences. But I do think that what's missing a little bit in this discussion today is the evolution of public markets. So, teeing off what you said, private markets have become much more available to investors with trading and other things that used to be the purview of public markets. And so I think that the type of landscape that we have is not as bifurcated as perhaps it used to be between public and private, that now there's more of a continuum where issuers can choose to be in, and sometimes they're in both. And so they offer advantages in certain contexts. And it used to be you registered as a public company, you traded on an exchange, and now those two things don't always have to go hand in hand, and they can be actually split apart. And I think that to watch where that goes in the future, I think we're going to see a very different landscape than we have seen in the past.
I'm going to look for some questions from the audience. Yes. Please identify yourself.
Okay. My name is Jack Katz, and I'm a retired faceless bureaucrat. And my question actually is for you, Mr. Bailey, and it's a comment you made that it is a desirable outcome to have uniform global regulation. And my question to you is, earlier today somebody mentioned how fundamentally different the U.S. financial sector is from the rest of the world, and that ours is a financial sector dominated by the capital markets, not the banking sector. Europe and much of the rest of the world is fundamentally a financial sector dominated by banks. Why would you want a uniform regulatory system for two fundamentally different structures?
It's a good question. And remember, as a moderator here, I'm trying to be a devil's advocate, but I'll own up to the fact that I would like to see some greater uniformity to the extent it's possible, because our banks operate overseas, foreign banks operate in the U.S. A lot of these financial products are global. So I don't think it has to be exactly the same by any means. And I realize that it is a somewhat different system, although, as Paul said, they are trying to converge a little bit more towards our system. So I think it's finding the right mean between not putting institutions or markets in the position where they have to try to figure out what is a U.S. person as defined by the U.S. as opposed to defined by someone else, that there's greater uniformity there. But let me throw it back to you, Paul. What do you think is the right balance between having a reasonable match in regulation or preserving regulatory structures that are suited to our system?
Well, as the French say, vive la différence. I think that's what makes competition and experimentation really makes a huge difference. And if you have a stultified atmosphere, like I would argue one has in Europe, you get the result of stagnation and lack of growth, lack of innovation. And in the United States, because of how big the country is, our traditions of federalism and things like that, I think we can live with differences. Now, whether if you have exactly the same institution and, one is treated differently than another, with respect to, say, banks and capital, then I think that's a problem. And to try to have, a level playing field so people can compete, that's okay. But where that then kind of dissolves, at the margins, I think is a real problem. But I would point out with the banking regulatory system that we have, again, which is completely non-transparent, you have the prospect of the bank regulators treating different market participants, even under their own aegis, differently, because you have examiners doing something in one respect and not in another. You have underwriters out there trying to issue securities to the public markets. They don't really know what's going on behind closed doors. And so investors are out buying securities of banks without necessarily the full picture. So I think the whole bank regulatory scheme needs to be rethought, and that, I believe, is one of the causes of the financial crisis, the lack of transparency with respect to many of these institutions.
Do you have a perspective on that?
Well, as a former regulator, one does worry about regulatory arbitrage. And
I was going to raise that, yes. So it's a good point to talk about.
Right, and so the issue of having...
And some activities have migrated from the U.S., right? HSBC is talking about migrating from London, so this is not a trivial concern.
No, it's not a trivial concern, and it is certainly something that regulators are cognizant about. It is difficult, there can be a race to the bottom in regulation for countries. We've seen that in the past, and having our best companies want to remain in the U.S. and not be trying to find the look at the amount of cash that's being held overseas because of tax policy, right? So we want to make sure that we're having the right kind of economic development in the U.S. that fits with the regulatory environment, and not have them searching always for ways around it.
Right. More questions?
Hi, my name's
But I do want you to keep it fairly short.
Oh, I'm short. Yes, you were the commissioner, right, for the SEC, Paul Atkins, right?
Yeah.
Do you hear me? I've been trying to find the financials for the securities and different exchanges, like the New York Stock Exchange, the NASDAQ, Chicago, and all these exchanges. What is their income? Where can you find all this data? And like Ms. Kathleen, you did give, the 2% proceeds, 7%, 15% of, what was 400 and 500,000 for per year?
We can't get too much into the weeds. I don't know if you can give a quick answer to that.
It's essentially the income of these government entities, really. They are.
They're not government entities, the exchanges.
Well,
they are.
I mean, they're under SEC control.
Right. So to the extent that they're public, then you can find out, their information. NASDAQ is a public company, for example. So there are, they file annual reports and quarterly reports and things like that. So you can find out, what their income is and expenses and the outlook of the management, that sort of thing.
And SEC does have a budget that's reported.
Yes, it's on the website.
The SEC files an annual report every year, and so you can see what the SEC itself spends. I mean, it doesn't really have revenues, but anyway.
Okay, one last question. I could answer that one, but I'll let these guys answer.
It's funny. I testified before House Financial Services. I guess goes back maybe a couple of years, and I put in it was about how to improve the SEC or financial regulation. I can't remember the topic, and so I put in my testimony that ultimately the SEC and CFTC should be merged. And so
good for you.
So former Chairman Frank at the time, he had just passed the gavel on Spencer Backus, but he was looking through the various testimonies, and he said, "Who was one who said that SEC and CFTC should be merged?" And so Harvey Pitt was there with me. He said, "Was it you, Chairman Pitt?" And I said, "No, it was I." And so he said, "Oh yes, okay." So Commissioner Atkins, I wanted to have that done, but the powers that be, would not do. There are too many political aspects to it between the various committees of Congress, vested interests of people. I think even after MF Global, if the two agencies, there's not political impetus to do it, I'm not really sure that will happen. Maybe someday, but we'll see.
The Volcker Alliance is pushing for that, among other things. So
they're pushing for other things. I don't think they have much hope.
So, do you agree that
it's a political issue.
Okay, on that sort of positive note, or at least thank you both very much, and our absent friend Greg. And thank you everybody for participating.